Over to you, Paresh sir. We are live.
Hello and welcome to another episode of In Conversation With. In Conversation With is a management series by CASI Global New York, where we invite senior professionals from across the world in search of executable advice. So my name is Paresh and I am the member of the board of directors for CASI Global at New York. We are the world's largest platform for sustainability with a presence across 52 countries. We also manage a pretty large volunteering organization with a reach of 3 million volunteers. So thank you all for joining us today. Before we start with Krista's presentation, I have a question. Anyone may answer it. Please give me a short answer. This is a general question. So the question is, when a green bond is issued for a specific purpose, and then the money is used for related purposes or a purpose which is not in the core purpose, then that is not considered a default. So what really happens is money is accumulated as green bonds for tax implications and then used for multiple other purposes. How does it work? Is that so? Krista?
Well, good question. It really depends on the issuer. We would hope not. We would hope that to maintain integrity of what is still a relatively new market segment, the funds would actually be spent as they are intended to within a framework or otherwise structured and reported on. But I can talk about that a little bit more in my presentation as well.
But as per the current scene, so it is still not considered as default if the money is used for other purposes.
No, and there's really kind of limited mechanisms to figure that out unless the issuer of the green bond will sort of openly tell you. Sometimes that is the case if the issuer is a so-called pure play. So for example, a 100% renewable energy generation or transmission or otherwise kind of engaged in that type of sector, then they are free to spend the money as they wish for general corporate purposes. But for most other sectors, I would say, for industry sectors, there needs to be a clear ring fencing and allocation mechanism to be considered a credible climate aligned investment, let's say. Okay.
Prabodhaji, one question to you. You come with a background of one of the largest cement companies in India. Now, when someone like you issues a green bond or an impact bond or a climate bond, we have this long-term versus short-term, and the cement supply chain is usually a long-term supply chain. So the repercussions or the effects in profits are long-term. Is this a hindrance for cement companies when they come to raise impact bonds?
I don't think it's a hindrance, because when you raise your fund for a specific purpose, as you asked earlier, so it is expected that the fund is spent on those specific purposes for which you have raised. If it is a green bond, you spend for the green energy. Or if it is a sustainability linked bond, it should be spent towards the purpose for which you have raised the bond. And during that period, because the impact will definitely be over a long term, but that doesn't mean it will be a hindrance.
Okay. So are the investors not shying away from really long-term projects like cement companies, or have the investors matured up and are looking proactively at supply chains of cement companies?
No, I don't think they are shying away. So first of all, we have not raised yet any sustainability linked bond on our cement operation, on JSW Cement. We have raised it for green bond in energy and sustainability linked bond for steel. But as you raised the question from my previous experience, or I think you are referring to Ultratech, where I was working in AVG earlier, and they raised the first sustainability linked bond. No, I don't think it will be any hindrances. Our investors are shying away, because what we saw.
Thank you very much.
What we saw, the response from our recent experience, when we raised a 10-year sustainability linked bond, and it was oversubscribed by 5.6 times, that itself tells that investors has a confidence.
That's a great show of confidence in your company, sir. Absolutely. Let's move on to Krista's presentation for the day. Krista, please tell us your opinion on the bonds.
With pleasure. Just bear with me as I share my screen and then we can get going. Right, so. Okay, so thank you for having me today. It's a pleasure to be here. I'm going to talk you through essentially what the different types of sustainable bonds and the mechanisms for this type of financing are out there and what the global landscape looks like. And the race is really on because we need to get to net zero by 2050, but that also means that we need to have the emissions current trajectory by 2030. So all of this is potentially very helpful as long as, as discussed just now, we can do it in a way that is credible and actually can demonstrate the requisite impact. And my name is Krista Tukianen. I'm the head of market intelligence for Climate Bonds Initiative, which is an international investor-focused non-governmental organization. And we, for the past decade or so, have been on a mission to mobilize the bond market, which is the largest capital market segment, as you know, for climate risk solutions, I should say. So climate mitigation, adaptation, and resilience building across all sectors of the global economy. And we do this with a few different ways. I'm not going to go into this in too much detail, but if you want to discuss any of this, you can get in touch with me. We can make the slides and my contact details available. We help to define science-based standards for green finance and social and sustainability finance, so all types of impact investing in the debt capital market side. We also advise on policy matters related to building these types of market segments globally, and we provide market intelligence in the form of key research to guide investor decisions and also raw data on these markets. So all the figures that I'm quoting today are based on the databases that we've managed for the past decade. We also facilitate, stakeholder networks, events and training, and connecting sort of investors to opportunities. So this is a very salient conversation to have folks from the corporate side here as well today. Just to take a step backwards, what do we mean by sustainable debt? Could be any number of formats. I've listed a few here on this slide, but the idea is, as Professor Sheth has said in the beginning, that there needs to be a specified use of proceeds for these debt instruments. Now, more recently, we've also seen debt that is linked to targets at the entity level, mostly for the corporate side, but this will probably be rolled out to other sectors of the economy quite soon as well. But in essence, the only distinction is that you need to be able to ring fence your use of proceeds, i.e. the funds that you raise from the capital markets, to certain assets, projects, activities that have a climate or environmental or otherwise sustainability benefit. And what have we seen so far? So this market segment is led by green bonds, definitely. This is still the largest segment, and it's growing very aggressively right now. It was started by the European Investment Bank all the way back in 2007, very closely then followed by an issuance from the World Bank in 2008. And since then, we've seen aggressive growth, especially in the past 5 years or so, now reaching a cumulative total issuance figure of $1.4 trillion US. Now, if you saw the number that I quoted just now in the beginning, this is still only a small fraction of the overall bond market, but it is indeed growing. And we've already seen this year, 2021, break the previous year's record, even though we've just finished the third quarter. So we still have the busiest quarter usually in issuance ahead of us. And that means that we are on track to have an annual 1 trillion of green bonds, perhaps as soon as 2023, so in about 2 years' time. And this is not just green bonds, as I've mentioned, it's a diversifying landscape. So we've seen a number of different labels and themes of sustainable debt emerge in the past couple of years, especially in 2020, which is obviously a response in part to the pandemic and changing economic conditions. Because of that, so we've got green, sustainability, and social debt, which is the use of proceeds format. And then we have transition debt, also potentially in a use of proceeds format. And we can talk about the distinctions therein in more detail if we have time. But the interesting development is indeed the sustainability linked bonds, which are tied to entity level improvements in sustainability performance. And therefore, the cost of capital is determined by the realization of those improvements. But I should say that the total of these right now in terms of outstanding volume is nearly $3 trillion. So it means that there is indeed a large universe out there that isn't only green bonds. Why this is important is, as we've heard in the beginning as well, sustainable finance can firstly benefit any actor in the economy. Anybody can issue a sustainability themed bond. And some of the benefits that we've found through our research over the years, I've quoted one of the surveys that we published in early 2020. We've seen verifiably that the issuance of especially green bonds has the opportunity to broaden investor bases for the issuers and offer new engagement opportunities. Higher demand, we heard oversubscription rates there already, and also stickier investors. So for example, in the tumultuous conditions of sort of midway last year, green bonds were the last assets to be sold off by investors because they are viewed as less risky than their vanilla counterparts. There are obvious benefits with reputation, visibility, and also importantly, the mechanism has the ability to contribute to the very urgent low carbon transition and the risk management therein, so that we are able to transition in a just and orderly way and future-proof these sectors that are so integral to our economies. This all rests on some antidotes to greenwashing and sustainability washing. So I just want to highlight to you that the first classification system to be built to try and outline really in great level of detail and in a science-based definitions way was the climate bonds taxonomy, the first iteration of which was released in 2013, and it's since been updated numerous times. This has since given rise to a number of other taxonomy processes, i.e. national or regional classification systems for green and sustainable investment all across the world. And I've given a few examples here. This comes from the Future of Sustainable Data Alliance, or FOSDA, which we're also a member of, who've created this really helpful graphic to show you where there's regulation or guidance already in place, which is, fewer places, but under development, lots and lots of other areas, including major economies like Canada and Russia. And there are discussions of possible taxonomies underway in many, many more places. And we're involved in a number of these discussions to make sure that what happens next is that there is indeed a robust mechanism against which to assess all of these new bonds that are coming out into the market. And really what we think needs to happen next is we need to make it easy for actors across the economy to know what to do to not get inadvertently blamed or accused of greenwashing or sustainability washing. There's already a harmonization process underway with regards to the EU's set of definitions in their taxonomy and that of the China Green Projects Catalog, which is fantastic news. We hope that other major economies like India and the US will jump on board that. And also we need to make sure that we take into account in those processes the transitions that are required for key aspects, like making sure that it's a just transition and it takes into account emerging markets, high carbon industries, and for example, land use, which is kind of absent from the conversation at the moment. Incentives and regulatory support are an obvious enabler to this, and really we can't make this happen without that. And then there's also a green window for trade. You may have heard of the EU's proposed carbon border adjustment mechanism, just one example of leveling the playing field for everybody going forward. That's it in terms of my slides. I'm happy to have a conversation about any of these topics. And again, thanks for having me here today. Paresh, I think you are on mute. I can't hear you, but I can see you speaking to us.
So sorry. Yeah. So thank you for that presentation. A couple of questions before we move on to Prabodhaji's speech on sustainable bonds. When you say level playing, it is not really a level playing field because most countries are not giving tax incentives for sustainable bonds. So really, where do the investors benefit? Investors from maybe Europe or UK, they benefit the most. Is that how it works?
It depends. You're right that there aren't enough tax incentives for this, and this is why I mentioned the carbon border adjustment mechanism, because there has to be a whole regulatory framework around diverting capital, but also resources away from carbon intense sectors into lower carbon alternatives like renewable energy when we talk about the energy transition. And I think, yes, probably mostly it is developed market investors right now who are benefiting from all of the capital markets developments that have taken place recently, simply because of the way that or the stage of development of those capital markets. But that's not to say that there aren't amazing opportunities in the emerging markets for both domestic as well as foreign investors to get on board. But it rests on, I would say, the regulatory framework and the definitions to make sure that you can spot the opportunities that are credible and deliver the kind of carbon reductions that we need, but also don't mean that you have to forego returns in the immediate term. And this obviously it's a risk management tool for all types of investors, because if we wait too long, a lot of the high carbon intense assets will basically lose their value, that they'll become stranded. So the time to act is really now. But yes, we have a long way to go to a truly level playing field.
Okay, so is it true that carbon bonds offer lesser rate of returns than normal bonds?
Well, there is not a simple answer to that, but I will say that based on the 6 years and I think around 15 research pieces that we've done on the existence of a so-called greenium, we have found that that's not the case. Green bonds perform at least as well as their vanilla counterparts, if not better. And there is a clear in certain types of green bonds, because you can only do analysis for certain sizes, currencies, where you have a comparable set of vanilla bonds that you can actually do an apples to apples comparison. The issuers are rewarded. So investors are willing to pay a premium to get a similar yield, but that means a lower cost of capital to those, for example, corporates that are showing that they're acting on climate now instead of 20 years into the future.
So what would your advice be to large corporates in a country, let's say like India? We are into manufacturing. We have a manufacturing background. We have 1.5 billion people. We could do a lot of good with carbon bonds, but we are not there yet in terms of tax incentives or even consulting. We lack the basic infrastructure for a company to go out and say, okay, this is what I want to do. So what would your advice be to large corporates, let's say large top 1,000 corporates in this country? How should you go about this?
I think the first thing is to map out what you can do in terms of your net zero strategy. So work with consultants or your underwriting banks or whoever you think has the kind of, or with us to map out what a transition looks like for you, communicate that clearly, and then start to invest in it. I would say, this is not going to be a simple thing overnight transformation, but certainly in the areas of energy and feeding sort of manufacturing processes with as much renewable energy as you can, there are vast opportunities for Indian corporates to do that. The country is building so much renewable power capacity all the time that there's opportunities to get involved, and then get access to foreign investors with being able to demonstrate that your strategy to get to net zero with whatever time frame is reasonable is actually credible, and that you're serious about that change. Because there is, and I hear this all the time from our investor partners, they want to invest in the emerging economies, including India, because it's one of the largest alongside China, but they're finding it difficult to pinpoint opportunities because of a lack of disclosure around what the corporates are actually doing. So it can be as simple as that. That would be my sort of quick take on that.
Somewhere in your answers, you mentioned renewable energy a couple of times. So are you implying that renewable energy should be the way forward to raise bonds and not supply chain revamping for manufacturing?
Well, it's a part of the supply chain, right? Because to be able to do the actual manufacturing, you need power, and that power cannot come from coal for much longer. And then, of course, look into the raw materials. It depends on what you're manufacturing. Then we get into sort of metals and mining, like we were discussing just now earlier before starting this conversation. And it's also worth, as corporates, thinking about getting involved in the conversations that are happening around setting standards for green investment. They know their supply chains best. They know what the salient issues are. And there are harmonization and efforts and classification systems being developed that would apply to them, so they can map out, which parts of the supply chain can be financed how, and where to source the potentially better alternatives to raw materials as well. So yes, it has to be a cross-cutting effort, but if we don't fix the power component, then, and I'm sort of exaggerating a bit here, none of the other stuff will matter at least as much.
Krishna, one more question. You guys work like a think tank. You guys enable corporates and entities to, raise bonds, reach out to the right people, reach out to
Yeah.
investors. Tell me something in your experience. What is
Yeah.
the minimum amount of bonds that people have raised? The minimum amount, bare minimum amount.
The smallest I've seen, and I checked this before this conversation, is $400,000, and the largest is probably as a single issuance the European Union social bond, which was 18 billion euros. So anything from that range.
So
But
$400,000 can also be done.
it can be done, yes, and often those are done as private placements. So you've already identified your single investor who will buy all of it, but I would say if you're interested as a corporate, for example, to getting access to foreign capital markets, then it's worth thinking about issuing benchmark size and in a hard currency. So those are the things. Otherwise, it'll be limited in terms of who can buy the debt.
Okay. Usha ji, thank you very much for joining us. Krishna, Usha ji is a very senior finance professional. And she has joined us. Specially, I requested her to join because she will be working with us at the upcoming ESG exchange, on the investment banking side. So, Usha ji, thank you for joining us. Prabodha ji.
Right, Parisi. So,
Yes, sir. Prabodha ji, thank you very much for joining us today. Please tell us your opinion on the bond.
I think Ushaji's microphone is on or something. Yeah, thanks. See, I would like to share experience rather than providing opinion, Parisi.
Yes, sir. Please.
The reason here is that, JSW, we have raised initially a green bond for JSW Hydro. We raised around 707 million US dollar. That was our first experience with Regulation 144A. Then recently in steel, we became the first steel company to raise sustainability linked bond. And that we raised in two tranches. One is for 5 years, another is for 10 years. So without going to the debate of my opinion, whether vanilla bond does good or whether sustainability linked bond or green bond will do good. But one thing I can tell you that I completely agree with Krista when she was presenting how the benefits, more and more investors will look for a greener credential or sustainability credential, and that's going to become apparent. So it is going to become a hygiene factor now for the corporates if they want to raise money for investment in the terms of bonds. We found some advantage in our green bond and sustainability bond, but that cannot be generalized. So with that, let me share my experience, because steel sector is a hard to abate sector. It's very difficult to follow a science-based target initiative to decarbonize specifically in Indian steel sector. And therefore, what we have proposed and how investor reacted, let me just share that framework. Possibly that will help for the audience to understand how JSW went ahead and raised the bond, if that is okay. I'll just share 2 slides and then we can take questions. Just a minute. Okay. Hope it is visible to you.
Yes, sir.
Okay, this is about the sustainability linked bond. We aligned our framework, and let me know what is the let me explain what is the process. Everybody might be knowing, but the fundamental thing is that if you want to raise any green bond or sustainability linked bond or social linked bond or sustainability linked loan, the first thing is that organization has to put forward a framework. Right, that framework has to follow a structure. We followed the sustainability linked bond principle as given by ICMA, and these are the different 5 requirements that you need to follow. So we followed our KPI. We decided that our KPI will be CO2 emission. GHG CO2 is important for steel sector, and we restrict to scope 1 and scope 2. The reason, because for the steel sector, specifically for JSW Steel, these two emissions are material. The scope 3 emission is hardly less than 1%. So therefore, it is important to focus on CO2 emissions. And next part comes is that you should define your targets. That means if you don't meet the target, you have to pay the penalty. So we set a target that by FY30, we want to reduce our emissions by 42% from 2005 baseline. That translates to 23% from FY20 baseline to achieve 1.95 ton CO2 per TCS. And then we give commitment what are the bond characteristics, how we are going to report, and verification. Obviously, after you make a framework, it has to go for a second party opinion or an independent opinion. In our case, we sought the opinion from DNV in case of the sustainability linked bond and JSW Steel. And we did that for green bond from Sustainalytics. Now let me give a rationale of what we proposed and what are the lever we wanted to follow, what is the rationale, and how investors reacted. So this is what we proposed. We proposed that we will follow a pathway that is proposed by IEA on the sustainable development scenario. So therefore, that pathway, if I have to follow, then by 2030, JSW's energy CO2 intensity should be around 1.95. And that was considered more aggressive when you take into account of the national NDC of India's and Paris commitment, what translate to around 2.4 in Indian steel sector. And then we propose that we will achieve 1.95. So these are the levers. The levers, basically, the first lever is to have a energy transition towards renewable energy. That means we do not want to use any thermal coal for our electricity requirements. Then how we can reduce the reductant in the blast furnace or in the reduction process of the iron ore. So the third is that how we can increase the scrap use, and then we rely on the available best technologies, and then the process improvement. That is what was the plan. And this is the path forward, and that that showed much interest, and we could gain the investor confidence of the target what we have set, and that helped us in the bond getting oversubscribed by more than 5.6 times, and that is how we raised the bond. So this is where I want to stop here, just to give a overview of what we did. But it will be interesting to answer any specific question or follow-up questions you would have. I just wanted to share the example.
Thank you very much, Prabodhaji. I don't have a question right now based on the slides that you showed us. Dr. Mitesh, do we have any question right now? Ushaji? Krista, you can.
Yeah, I actually wanted to just say this is really a commendable example of what you can do as a corporate, even in a really difficult industry to decarbonize. And I like the reference to the IEA pathway, and also the sort of contrasting with the nationally determined contribution of your country of domicile as well. So well done. It's great to hear a practical example. Thank you.
Prabodhaji, tell me, there are a lot of steel players in India, and not everybody is strong enough there like JSW. So JSW is like 1 in a million company. But there are a lot of mediocre, smaller steel companies, cement companies working on the supply chain. So what would your advice be for these companies? How do they work on the targets that you have set for yourself?
Okay, I think, Parishji, I should give also some of these backgrounds of why we set a target and how it was considered initially, because you need to know the global scenario. Now, if you look at the global scenario in steel making, we have set a target of 1.95 by 2030. Globally, the average emission from steel industry is 1.85, right? So on the first side, if you are comparing the global average, we are setting a target much higher than global average, right? But that is where we want to bring in that regional differences, technological differences has to be included while you set a target. So in the context of your national situation, in the context of technology availability, this target which appears in paper that higher than the global average emission in steel sector still got the investor confidence. No, we are in the right way to decarbonize, because we are showing a pathway. And I think Krista commented on that we are following IEA's sustainable development scenario, and the pathway takes us to that emission, which might look little higher, right? And that is where I don't see any steel companies in India has a disadvantage with respect to JSW. The question is your intent, and the question is to put things together and work towards it. See, like any other sector, steel, cement sectors are difficult. We know that is why it is called hard to abate sector, because it is not about energy transition, which will bring you your reduction in the emission. It is all about your process emission. The process itself that it will give emissions. Now we can't eliminate the process until you get a greener alternative like hydrogen, because instead of carbon reductions you put hydrogen reduction. And in the cement, instead of lime you find something else, because calcium carbonate gives you CO2. So these are hard to abate sectors. So that difficulties people understand. So the question here, like JSW put forth a case, and we become the first time in steel industry to put that that confidence to this sector that no, I mean, we can have a pathway, work towards it, and if we can clearly communicate our intent, and if we are serious, considering the current technological scenario and the challenges, investors are willing to take that. Because you are transparently telling your difficulties, but at the same time you are demonstrating a pathway by which you can reduce your emissions, and you are working towards it. And the levers which I showed you, those are very feasible and implementable, yet it is not easy. It's not a business as usual. So you need to little stretch.
Tell me something, a quick query. When you were trying to implement these reductions in CO2 and move on to being a better business, does it really stretch your bottom line? Does it impact your bottom line? Was it a fight? Does it become a fight?
Does it impact to your bottom line? Yes, it impacts to your bottom line of a business. Does it impact positively to your bottom line or negatively to your bottom line? I would say it impacts positively. I'll tell you, Paresh, let us be honest. Everybody, we are doing a business, right? Everybody are in business. So what is the objective of a business? I think we discussed last time also. The objective of business is to have a healthy bottom line. If there is no healthy bottom line, the business itself will not exist. That means tomorrow fossil fuel, if it doesn't have a healthy bottom line, it will not exist. And why today renewable energy is gaining importance? Because the bottom line is getting healthier. So at the same time, sustainability is all about building sustainable businesses.
Correct.
By reducing CO2, by improving your efficiency, actually you are improving your bottom line. And that message until you give, and we being in sustainability professional, if you don't give that message, we'll not be able to drive business towards a sustainable pathway. So it is not necessary, what I wanted to give the message, it is not necessary that sustainability is a cost.
No, I absolutely agree with you, sir. But what happens is, since we are working in 52 countries, and not all of them are developed countries, we work in a lot of developing countries, and investors there constantly have a uptight opinion, saying no sustainability bonds, don't talk about sustainability right now. First, let's get a decent return on my investment, and then let's talk about sustainability. So usually in a lot of countries, in a lot of places, the investor feels that if you invest in sustainability options, the return goes down, and you're too happy that you're making the world a better place in lieu of the money that you lose. So that is a popular opinion in many places, and that is why I specifically asked this question.
No, you are absolutely right, and that message has to go. Now we are facing the other questions from investors the opposite, that they are telling if you are not doing a business in a sustainable way, you will not be able to manage your business. And therefore, it is necessary that you do things rightly.
Correct. Absolutely, sir. Absolutely agree with you. Dr. Mitesh, you have a question from the viewers.
Yes, thank you. I have received a question from our viewers. She's from Pratap College, Amalner. This question is towards Krista. Krista, are there any special tax benefits for corporates issuing green bonds?
In certain jurisdictions, yes, there are tax breaks for the issuance itself and some incentives towards helping you cover the additional costs of, for example, building a framework, which that mentioned, but they're very rare still. I think a lot of that driver towards the transition, especially for corporates, is going to come from investor pressure rather than regulation in the immediate term, as in you will not get access to capital at all at some point if you're not showing green issuance or sustainability credentials. And by the way, it doesn't have to be green bonds as such. It doesn't have to be a labeled bond. You can continue to issue all the vanilla debt that your heart desires if you have the other bits of the puzzle in place, i.e. a credible transition or transformation strategy even for certain industries. So that's a bit of a broader answer, but I just wanted to contextualize that.
Thank you.
Thank you very much for that. With that, we come to the end of today's program. This was amazing. I forgot to tell you, this goes live on our learning management systems. So we have 1 million+ students who view this on our LMS systems. So the questions usually come from that, the learning management systems, and it also goes live on YouTube as a record. So and this will be circulated to over 10,000 corporates across the world. So thank you very much, Prabodhaji, for being with us today. Thank you, Krista. It has been a wonderful experience listening to both of you. I have a lot of queries, but I want to take it offline because those are business level queries. But thank you both very much. Thank you, Ushaji, for joining us. Thank you, Dr. Mitesh. Thank you all very much. Thank you.
Most welcome. Thank you.
Thank
Bye-bye.
you so much for having us. Have a good day.